A financial security trader is discussing daily MA50 and MA200 crossover. A financial security trader is discussing daily MA50 and MA200 crossover. Good morning, good afternoon, good evening, bonjour, bonsoir, mes amis, guten Morgen, guten Tag, guten Abend. For those of you who are new to us, we are the TSTW 24 traders, and our website is www.stochastic-macd.com. The title of the video is A Financial Security Trader is discussing daily MA50 and MA200 crossover. All right. The MA stand for moving average. Okay. M for Mike, A for Alpha, MA stand for moving average 50 and moving average 200. All right. So we are talking about the crossover between the moving average 50 and the moving average 200. I'm using here the simple moving average 50 is the red line on my chart, and the simple moving average 200 is the blue line on my chart here. Okay. So we are discussing the crossover between the moving average 50 and the moving average 200. All right. On the daily chart. All right. The phenomenon of moving average 50 going below the moving average 200 on the daily chart, repeat, on the daily chart, no weekly, no monthly, no hourly, on the daily chart, is a very important phenomenon in the financial market. All right. Whenever the daily moving average 50, okay, dip below the daily moving average 200, the market is considered bearish. On the other hand, when the daily moving average 50 goes above the daily moving average 200, the market sentiment is considered bullish. All right. So if you are a new trader, you need to understand that trader also talk about a death cross. The death cross is when the moving average 50 dip below the moving average 200. All right, on a daily chart. Now, what usually take place, I want you to understand this clearly. That's why we are doing this discussion. So normally we should have an uptrend, a strong bullish trend in place. So you want to know when and where does the crossover, the best moving average 50 and 200 crossover will take place. It will take place at the end of an uptrend. So price was going up nicely. We have a strong bullish trend. You will see the trend clearly on the monthly chart, because there is a connection between the monthly chart and the daily chart. Okay, so you will see a clear bullish trend, price in a rising channel on the monthly chart, and then suddenly on the daily chart, you will see the moving average 50 dipping below the moving average 200. That's what they call the death cross. The market sentiment at that point in time, theoretically speaking, is considered bearish. And most of the long-term investors will start divesting. Okay, so they will start selling the stock that they own. They will start clearing their portfolio because they think that the market will go down. All right. Similarly, professional technical traders that are trading stock will start giving priority to bearish signal, because they say that moving average 50 dip below the moving average 200 on the daily chart, provided that on the monthly chart we have beforehand, okay, a strong trend in place. The opposite is also true for the best moving average 50 and 200 crossover on the daily chart. We want to see on the monthly chart a bearish channel on the monthly chart, a strong bearish trend in place on the monthly chart. And then suddenly on the daily chart, we see that the moving average 50 goes above the moving average 200 on the daily chart. This is good news for investors. So investors that hate to sell will come into the market once they see that the moving average 50 goes above the moving average 200 on the daily chart. After a downtrend, they will start buying stocks, giving priority, and the technical professional traders will start giving priority to bullish signal. I want you to understand this clearly. Monthly chart trend in place, and then the crossover on the daily chart. Okay? Now, there are more to this, because the market sentiment will affect market participants. So, majority of market participants will become bearish when we have 50 going below the 200. The simple moving average 50 going below the simple moving average 200. So the MA stands for moving average. So see if I talk about MA 50 and MA 200, MA 50 mean the moving average 50, MA 200 mean moving average 200. I'm speaking like this for new traders, okay? All right. So now, recently, in the stock market, we are in 2015, by the way, in case you are watching this a few years later on, all right? So we see this crossover taking place on the daily chart of, the S&P 500. We want to check whether this is, normal or what is taking place here, okay, so we can make excellent decision. And also we'll discuss how technical traders will trade this and how to avoid trading mistake when we have a crossover, and what are the common trading mistakes that traders are making when they see a crossover, okay, a moving average crossover, okay. So I'm going to go now to the monthly chart. We see now the crossover is taking place on a daily chart. 50 is the red line goes below the 200. So the market sentiment at this point is the S&P 500, which represents the Standard & Poor's 500. This is what we call the market, American stock, okay? So I'm going to go now to the monthly chart, okay? Stay with me. So on the monthly chart, we want to check whether there was a trend in place. So if you look carefully, look at the blue channel. It's a rising, beautiful rising channel on the monthly chart. So there was a trend before the crossover is taking place on the daily chart. So this is a normal, okay, bearish crossover, and the market sentiment will become bearish at this point in time. Now, I'm telling you, there are more to this, okay? Let's go back again to the monthly chart, okay? So some you will notice that some technical trader will scan for stock on a daily chart, okay? So you have a trading software like a TC2000 or trading station. You can scan for stock on a daily chart that where you look setting conditions that moving average 50 D below the 200 and moving average 50 goes above, okay, the 200. So the best strategy when you are scanning for stock, so if the global market is bullish, you'll be scanning for moving average 50 going above the 200. That's normal because you want to apply your strategy, a bullish strategy, during a bullish market, okay? So if the global market is bearish, you'll be scanning for stock when the moving average 50 goes below the 200, or aligning your strategy with the market sentiment. Or if the S&P 500 D below the 200, the 50 on for like we see now on the daily chart, S&P 500, okay, 50 D below the 200, okay, you want to look for stocks that are doing exactly the same thing. And as you are receiving a sell signal for the S&P 500, you will be applying the same thing for other stock, all right? If you're applying that for a sector, you do the same thing. Okay, now we have the trend in place, my friend. So are we trading the moving averages or are we trading the price? Now, traders that are following and know that we are trading the price, okay? So what usually takes place, people get carried away with emotion in the financial market, okay? So don't get carried away with emotion, okay? So this is it. It happened here. So the price went down. You see here, it went down fast, okay? So now people want to sell. But look, all this day, the price was going up. Then it went down. Then it went up. So where do you sell? Or when do you sell? And how do you sell? Because of the bearish crossover. Okay? On the other hand, if you have a bullish crossover, where do you buy? And when do you buy? Okay? That's where this is about the timing. Okay? So let's go back again to the monthly chart because it's where everything is taking place. So look carefully, my friend. Okay, look carefully. So the move that you see, this is the beginning. So 2009 bullish market here started, and up to 2015. Okay, so this is now 6 years. This trend was continuing now, and we are here up here. Okay, so it's a bullish trend. Okay, but as the trend has started here in 2009, this is the beginning here, origin of the trend, and then we have this higher low. So at this point in time, the only channel that we will have on our chart will be this one. I'm going to color it now into green. I want you to pay attention carefully, okay? So we'll have this channel. At that point in time, that's the only channel that we can draw. A low and a higher low, and we select this point here, the third point, to draw our bullish channel. Then the price suddenly came out of the green channel. Now, because the price came out of this channel, we will project the channel in the direction of the price. So this is my projection now. I'm going to color it now in another green. So we have now two channels, two smaller channels. So this channel first was in place. Then now the price switched channel. Now I prefer this channel, the second green one. And that's where we are in now, okay? But there is a bigger channel from here to this level here. But concentrate on the second channel. So our trend was here, boom, 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 up, okay? All right? So we can consider the middle line as the median line of our bigger channel, okay? So the price was in this channel, the second smaller channel, okay? Now it's out of the channel. How do we sell? We are on a monthly chart, okay? So as a technical trader, price is out of a channel, okay? Also on the daily chart, we see moving average 200, okay? DP, moving average 50, DP below the moving average 200 on the daily chart. At the right time, because the price is in an up move on the monthly chart, let's draw a median line for our second channel here. Okay, so if you accept that, that's the median line of our second channel. So how do we trade this? As a technical trader, how do we trade this? Okay, how do we trade this? Okay, so one example is that price will come out of the channel and will come back and retest. You see this last month, it did below and came back and retested here. Trader will use a top-down trading method on the edge here to trade it. So you see, if you do that, it went down, okay? So price going down, so you want to manage it. If the signal change, you come out, all right? If the price violates the declining channel, you will know that the music is changing. Price failing to display a new lower low, you know that the bearish momentum is diminishing. And it has happened here. And the price change direction again here after this candle. So some traders that are long-term sellers, that are typical bearish traders, they sell and they forget. It's going to go down. That's the end of the market is going to go down. The market went down a bit, found a support. Now it's changing direction, second retest. So now, this is the month of October 2015. We are now on the 8th of month. The price retesting here. The best scenario for a technical trader is to wait for this monthly candle to close before we can say that there is a bearish trade setup, and then we'll apply a top-down trading method to see whether there will be, if there will be a bearish signal. It may not be any bearish signal at all. So if there is no bearish signal on the edge, price may go back inside the channel. So we can look for opportunity to sell on the edge of the channel. Sometimes, as you see here, the price may continue and go back inside the channel, seeking the median line of the channel. So people say, what's going on? You touch it here, it went down, found a support. If it failed to find a resistance here, now you continue to go and check this resistance, which is the median line here. And if it reaches this level, we apply again a top-down trading method. The top-down trading method allows us to navigate through the market and to avoid trading mistakes, investment mistakes. It allows us to time the market correctly because we see a setup, we validate the setup, we wait for a signal, and we select low-risk entry point. If the signal changes, we come out, we wait again. We want to trade on the edge. So though, if we go back again, let me show you now, we go back again to the daily chart. Talking about a financial security trader is discussed in the daily MA50 and MA200 crossover. MA50 stands for moving average 50, MA200 for moving average 200 crossover. So we are on the daily chart, okay? So there are different type of traders. So sometimes some traders trade like this. So moving average, you see here, cross is below the moving average. So this day here, so it become clear somewhere here, okay? So this day is truly below it, okay? So if you want to see truly a clear cut, we want to have a bit of hole. So here we can say clearly, definitely, it did below, it closed below the 200. So look at my candle here, all right? So it closed it. Some traders, as soon as the moving average 200, moving average 50 did below the 200, they sell, automatically sell. It was not bad because, you see, if you are a trader, you see, the following day the price went up a bit. So if you are not using a put option to sell, you may be taken out of your trade and before the price went down. Okay, maybe you use option, a put option to sell, and you went up, blah 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 blah, but finally, okay, it went down, and you are rewarded. People get away with it. Sometimes the moving of a crossover will take place at the wrong place at the wrong time, or the crossover will take place when the price is about to go back up. As you can see here, though the moving average 50 is below the moving average 200, which is bearish, what is the price doing now? It's going up on the daily chart, big time. It's going up. So do not trade the moving average crossover itself. Acknowledge the moving average crossover, but trade the price, as I show you now on the monthly chart, on the edge. Also on this daily chart, we see a triangle. Trade that I understand area with triangle. We have an expanding triangle on this daily chart. So this is the top of this expanding triangle. The S&P 500, as I explained to you, it may seek the edge of the smaller channel or the median line of the smaller channel, as I show you on the monthly chart, or there is another resistance here, which is the top of the expanding triangle. Price is heading to the edge, so let's color this line now into turquoise to differentiate. I've had other green on my chart, so the price is heading, okay, so to speak, towards this turquoise line, which is the edge of the expanding triangle. So very often the moving average 50D below the 200, the price will come back near the moving average 200 to confirm that the moving average 200, which was supporting the price, is now converted into a resistance level. So it's similar to price break below a support level, trying to repair the support level to convert that support level into a resistance level. So very often when the moving at 50D below the moving at 200, the price may fall down as you see here, but definitely the market will prefer the price to retest the moving average 200 to see whether it will find a support or a resistance. That's why we have this expanding triangle. The price slowly but surely will try to revisit the 200 to confirm or to transform or to convert the moving average 200 into a resistance level. You can see that before the moving average 200 was supporting the price, and now the price failed to find a support. It did below it, crashing out of our green channel. That's the edge of our lower part of our green channel. Now the price is trying to go back inside the channel, okay, which is the median line. You see near the median line, but in fact it's trying to retest the moving average 200 to convert, so to speak, the moving average 200 into a resistance level because it was before a support level. The opposite is also true in a downtrend. In normal downtrend, the moving average 200 will be suppressed in the price. So in fact, it's a resistance, okay, a dynamic resistance. In a downtrend, the moving average 200. If the price breaks above the moving average 200, after the moving average 50 goes above the moving average 200 in a downtrend, the price, okay, will pull back again, will try to pull back again to the moving average 200 to transform or to convert the moving average 200, which was before a resistance level in a downtrend. You try to convert it into a support level, and if you find a support there, then the price will resume the uptrend. But what is happening here is more complicated than what I'm saying to you now, because, okay, we can talk about it. Maybe you know about it, but if you don't know about it, go to 24elliottwaves.com, 24elliottwaves.com, or 24elliottwaves YouTube channel, all right? What is happening here is a corrective pattern, okay, for traders that are advanced. We have A, B, C chart pattern being formed, okay, or we have a flat correction being formed, okay. We will see what's going to happen, but so far we see that the price went down. Now it's in it's in an expanding triangle, okay. All right, are you with me? All right, but if you go back now, let's see. If you go to the monthly chart, you understand what I'm talking about. On the daily chart, we see it come down. You see it's showing an expanding triangle. The price will try to retest the upper side of the expanding triangle after we see the ABCDE pattern, and then it will come back down. Okay, I move my line now. Okay, and then it will try to come back down if you find a resistance there. All right, then it will try to come back down to form the C part of the ABC. Move down. So we are expecting, okay, one move down, and then, okay, another move up. That move up, this is what we call the expanding triangle. The expanding triangle is the second move, followed by the third move down. That's what I'm saying to you. Either we have, okay, a complex correction, this is not a proper, so we see A, B, C, double retracement. Then we see another A, another move up. Okay, we want to have a flat correction is being developed here. So I don't have enough room to draw on my chart. So what I'm talking about is something like this, my friend. One move down, which is this one here. Okay. The second move up, which is the expanding triangle. All right. And another move down. But remember, before that, we have a trend that was in place since 2009. So that trend was in place 2009 up to 2015. Then we see this move down, which is this one here. Now we are having an expanding triangle. Okay, we'll bring the price somewhere up to the edge of the moving average 200 here. So this is what so first move down is this one here. Now this is the expanding triangle here. After the ABCDE, which is the expanding triangle, is completed, we'll have another move down. But that's not the end. People will say a downtrend has begun. What we said to traders is that the stock market has a high chance to continue to go up to July 2016. This is our expectation. We may be wrong, or we may be right. If the price is doing exactly what we're expecting, we'll take advantage of it. The general public want to sell now, but I think people are a bit too early. If you are selling now, you are selling for medium term, but the long-term trend is still bullish until the correction is completed, okay? So in the medium term, we can look for opportunity to sell as this pattern is being formed, A, B, C down. But we're going to have a double retracement because the price will do something. After the price come back down to somewhere here, it will go back up again. People will say, what's going on? And then it will come down. People will say, yes, I told you it's going to go back down. And then to the surprise of everybody, price go up and forming a new higher high above the high of 2015. Right here, up, somewhere up here, in a zone of 138% Fibonacci extension zone. Now, Elliott Wave Trader, we see clearly that this is a double retracement, and this will be completed, the double retracement will be completed somewhere in around July 2016, and then the downtrend will begin. All right, the downtrend will begin. Okay, and then the downtrend will begin right here. So this is what we are looking at. So though we have a bearish sentiment because the moving average 200 crosses below the moving at 50 dip below the moving at 200, indicate in theory that the market sentiment is changing from bullish to bearish. All right, one cannot afford to sell and forget. We can now use the Elliott wave pattern to navigate through the market, to read the internal wave, to understand the language of the price, so we can sell at the right time, we can time the market, we can forecast the market, and know when and where we can sell, if we can sell, and know when and where we can buy, if we can buy, though the moving average of 50 is below the moving average 200. You can see that one can buy here if you understand, okay, what the language of the price and what is taking place here. All right, so Elliott wave traders can see that A, 1, 2, 3, okay, and now they know this is A, B, C, okay. So if I don't want to go into detail of this, but this is an expanding triangle. Okay, they will wait for the triangle to be completed first. We see the same pattern. So this is the S&P 500 that represents the market. We see exactly the same pattern being formed for the Dow Jones Index. Okay, let's go there and see it. Okay, Dow Jones Index coming up. On a daily chart, here it is, moving at 50D below the moving average 200. Market sentiment become bearish. Again, we see a move down, A, B, C. Remember, we're going to have a double retracement, another move up, 1, 2, 3, forming a double retracement, and then 1, 2, 3, 4, 5. So the 1, 2, 3, 4, 5 will start in July 2016. It makes sense? This is about a financial security trader. He is discussing, okay, daily MA50 and MA200 crossover. Though the MA50 and 200 crossover on a daily chart is a major event in the financial market. Traders also use this crossover, okay, on the hourly chart, on the 50-minute chart, on the 4-hour chart to make decisions, all right? But there are more to this. When a technical indicator gives us a warning, all right, the price must confirm the warning. Now, the price must confirm the warning by giving us a direct signal on the edge. Now, by giving us, okay, a trading setup, okay? So the warning is this: moving average 50 dipping below 200, or moving at 50 going above the moving at 200. Does not mean that buy or sell and forget. It means that know when and where you can buy or sell. If one does not know when and where one can sell, one can be in trouble. Like now, this is a great opportunity for some traders. If, for instance, we have A, B, C is completed here, this is a good time to buy again, okay, these stocks, and leave it on up to until we go above the high of 2015. It makes sense? It is also powerful. All right? I'm going to show you again. So to summarize this video to traders, okay, moving at 50 dipping below the moving at 200 is called what is generally called the death cross. It means that the market sentiment has changed from bullish to bearish, okay? Very often, if the moving at 50 goes above the moving average 200, is considered bullish. But we want to know the condition that in which this crossover will take place. In normal condition, the bearish moving at 50 and 200 crossover will take place after a strong bullish trend on which time frame? Monthly chart. Monthly chart. Very, very important. Monthly chart. No other time frame. Monthly chart. Before we can talk about the daily MA 50 crossover, we must first have, okay, a bullish trend on the monthly chart. Okay? The opposite is also true. Before we can talk about, okay, a bullish MA 50 and 200 crossover, we must have first a downtrend on the monthly chart. And then we see the bullish crossover. Now we can use the area wave patterns. We can draw channels and sell on the edge of the channel, the original channel, probably D below the channel, try to retest it. But very often the key thing to understand, the moving average 200 is supporting the price in an uptrend. As the price break below it, the price will slowly but gradually try to revisit, okay, the moving at 200. So one of the places that technical trader will look for opportunity to sell is when the price return back to retest the moving average 200. So a day below, blah, 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 triangle or no triangle, they want to look for opportunity to sell after the price retest the moving average 200 because it's a long-term, okay, indicator. Is becoming bearish, and they want to see whether that moving average 200 will be converted into resistance level. So this is a good place to look for opportunity to sell. So if a moving average 200 D below, the moving average 50 goes below the moving average 200 and you want to sell, the best place to sell is near the moving average 200. But as I show you now on the monthly chart, the channels and the price are irreplaceable, okay? So as I show you how we sell on the edge of the channel, gently, and apply a top-down trading method, that's the best way forward. The opposite is also true in after a downtrend, and when the moving average 50 goes above the moving average 200 on the daily chart, so price will okay, go up fast. So when the crossover takes place, price will rally up. But professional want the price to pull back again to retest the moving average 200, to convert the moving average 200 that was before a resistance in a downtrend, to convert it into a support level. So when we see a bullish moving average 50 and 200 crossover, the best place to buy is when the price rally and pull back to retest again. When the price was retesting the moving average 200, okay, that's when it's the best time to buy, okay, the financial instrument. But once again, one can use a channel, pitchfork tool, and trade the price, break below, retest, turn around, as I'm showing you here, that the first place trader will sell the edge of the channel, and the second place is near the median line of the channel. The median line of the channel Pay attention also to the moving average 200 itself. All right, it makes sense? If you like this video, please give us the thumbs up. If you dislike it, okay, give us the thumbs down. If you love this video, feel free to share it on Google+, on Twitter, and also on Facebook. If you love our videos, this is the time for you to subscribe to our channel. Check the link below in the description section. Feel free to subscribe to our channel so you may stay tuned and watch more tutorials like this. This is the end of this video about a financial security trader. He is discussing daily MA50 and MA200 crossover. We wish you the very best in your trading. And until the next time, enjoy yourself and be very happy. We are the TSTW 24 traders. Speak to you soon.